Welcome to the Three Edge Week in Review for the week of April 18th. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. In today's episode, Steve and I will be discussing a category of investments known as Treasury Inflation-Protected Securities, or TIPS. And we've incorporated investments in TIPS across many of our investment strategies to protect our client portfolios from the potential for increased inflation. And so today we'll explain a bit more about TIPS and TIPS ETFs and why we have included them in many of our strategies and how they work. First, a brief update of the global capital markets. And so far in 2022, inflationary pressures, the likes of which we haven't seen in the US at least for over 40 years, combined with the fear and uncertainty around the future direction of the Fed's monetary policy actions to combat inflation, have both stocks and bonds struggling. Both the S&P 500 and 7 to 10-year US Treasuries have declined appreciably thus far in 2022, while real assets such as commodities and gold have seemed to be one of the few places to hide this year, as real assets have appreciated in value year to date. Our model research is signaling that continued caution is warranted when it comes to both the stock and the bond markets, and that is reflected in our positioning. So now let's get started, and let's take a look at the market for U.S. Treasury Inflation-Protected Securities, or TIPS. So Steve, I think one way to start is to remind everyone that we've been talking a lot about the global capital markets undergoing what we would call a regime shift, moving away from a multi-decade long cycle of low interest rates and low inflation and into this period where rates and inflation could be materially higher for an extended period. And in response, we've incorporated investments in TIPS across our investment strategies in order to protect our clients from the potential for increased inflation. And so perhaps you could explain basically what TIPS are and how we use them.
TIPS, or Treasury Inflation-Protected Securities, are designed for investors who want protection from inflation that's higher than expected. One way I can explain the TIP is to compare it to a regular Treasury bond. So let's take the 10-year Treasury bond and let's take a 10-year TIP. They're both backed by the full faith and credit of the US government. So the only difference is this inflation protection element. So for a regular Treasury bond, you buy the bond, let's say that interest rate is 3%. You are guaranteed by the US government a 3% interest income every year, as long as you hold that bond. If you hold it to maturity at the end of 10 years, you get your money back. The difference with the TIP is that when you get your money back, you not only get back the original principal that you put in, but you get it adjusted at the rate of inflation for that whole 10-year period. However, the interest rate you get is not the 3%. It's the 3% minus whatever the market expected inflation to be over that 10 years. So let's say the market expects inflation to be 3%. Then the interest rate you get on the TIP is 0%. So now how do you choose between a regular Treasury bond and a TIP? The regular Treasury bond will give you 3% interest income and return your principal. The TIP, again, gives you the principal adjusted at that rate of inflation. So clearly, if you think inflation is going to be higher than what the market expects, you would be in favor of buying the TIP. Or if you just want protection in case that happens. Now, one way to make that decision is shown on the following chart. Here we have a graph comparing what the market thinks inflation is going to be and what inflation is currently and how it's moved up. And there's a big gap between the two. So clearly the market thinks that inflation is going to be very temporary and come right back down again. If you don't believe that, then TIPS are a good investment for you.
Excellent. Yeah, the chart, I mean, you look at that and you would think inflation expectations could certainly rise from here. So let's dive a little deeper and let's look at the choice that investors have when they invest in tips, right? Because there's a choice. You could have tips of different maturities, right? And for our purposes, we could say you could have a choice between tips with a longer maturity or tips with shorter maturities. And the decision of which to utilize speaks to one's, as you were mentioning, one's forecast, I suppose, of short-term inflation versus long-term inflation. So maybe if you could just go into a bit more detail, when might one want to invest in the shorter term tips, and when is it better choice to invest in the longer maturity tips?
So there are some similarities between the short term and the long term tips. They both appreciate at the rate of inflation. And right now, inflation is 8.5%. It's a consumer price inflation index that's used. So you get a clean start where all the tips are earning 8.5% appreciation. It's a fantastic starting point. Then the question is, do they gain or lose in principal value based on the change in the real interest rate? That's where the difference is between a short-term tip and a long-term tip, because a long-term tip might have an expected inflation of, say, 3%, where the short-term tip might have an expected inflation of 3.5%, for instance. The key is looking at what the market expects inflation is for that time period and comparing that with what the actual nominal treasury yield or the conventional treasury yield is. So you might believe that in the long term, inflation is going to be much, much higher than the 3%, and you're happy to buy the long-term tip. You're happy to suffer any short-term ups and downs, and you'll hold it to maturity, and you'll gain the difference. On the other hand, you might prefer the short-term tip because the long-term tip, inflation expectations don't move so much. People don't change their mind about 10-year inflation, whereas in the short term, they do. What that means is that when 10-year Treasury bond yields go up, the principal value of the long-term tip could get hit. And so there could be more volatility in the long-term tip. And if you want to reduce that volatility, just go ahead and buy the short-term tip. You still get that 8.5% gain now. And of course, that'll change as inflation changes, but you have less volatility in the principal value.
Excellent. So my final question, which I think you've actually gone a long way in answering with your very good explanation, but that would be maybe just to summarize, okay, we're in this period where we might see higher inflation for an extended period. What role do tips play in a portfolio then for investors?
So we like the idea of adding tips to the portfolio because of the inflation protection. We've been all along, you and I have been talking about this in videos a year ago, that inflation was going to be more persistent and more entrenched than what the market was perceiving. And we've been right. And I believe we'll continue to be right by saying that inflation will continue to be stickier and more persistent than even today the market perceives. So I do think tips are an important part of an overall portfolio. Also, in a stagflationary environment where growth is coming down and inflation remains elevated, regular treasury bond doesn't protect you because, again, if you invest in a regular treasury bond, you get a fixed income stream that's not going to go up if inflation goes up. It's just fixed. And then when you get your money back at the end, you don't get any inflation adjustment. And so because we think the market is still underestimating inflation, we'd rather be in the tip. Now, more recently, we moved from the long-term tips to the short-term tips so that we can gain that same advantage of getting the consumer price inflation rate appreciating for some time without having to get the volatility of the long-term rate at this point. So that's what we've done.
Excellent. So before we finish, I just want to briefly cover one aspect of tips if you are accessing the asset class through the index ETFs, which is the way that we invest. And the difference between investing in the individual tips bonds and the tips index ETFs is that at the individual bond, as you mentioned, will pay out a fixed percentage of principal as your coupon, right? And it'll do that twice a year. or semi-annually until maturity. And any inflation adjustment to an individual TIP bond principal, I believe, is paid at maturity.
That's right.
However, since TIPS ETFs are 40 Act funds, they pay out the earned income of the portfolio, including any inflation adjustment, on a monthly basis. And so investors in TIPS ETFs will be receiving monthly distributions into their accounts. And that is just something that I think, well, at least clients should be aware of and understand.
I think it's a very important point, Fritz, because I've talked to clients who, for instance, said, gee, in 2021, TIPS didn't make any money or they lost money. And I said, be careful, because if you just look at the TIPS price, it
Right.
might look like they're making money, but you have to remember those monthly distributions
Right.
are because of the TIP you own, and those should be added to factor in your total return. And so, for instance, in 2021, regular Treasury bonds had losses, but the TIPS had gains.
Absolutely right. And that is precisely why we chose this topic to discuss today, because, I think that to some extent tips, well, that might seem obvious, they're helpful if there's inflation, but there are aspects to it that are, just a bit more complicated than they seem on the surface. So thank you very much, Steve. And that will do it for us. But we'll be back again next week with the next edition of the 3 Edge Week in Review. Remember, all our videos are available on our 3 Edge YouTube channel. In addition, all our videos, all our written commentaries, and other information are always available on our website, which is 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3 Edge, thanks for listening.